Do you wish that all things wealth and finance were much easier to understand and not presented by a bunch of beige cardigan-wearing geeks? Welcome to the Clever Investor Podcast, where we're dishing up the easiest to understand finance program served in bite-sized chunks, so your brain will thank you as your knowledge grows. Hosted by the brilliant Owen Taylor, a multiple award-winning expert with a glorious knack for explaining the complex world of wealth in the simplest of ways.
Hello, Clever Investors, and welcome to another show. Now, today I want to talk to you on the back of people, probably the most stressful thing for first-time buyers is saving that deposit and how stressful it actually becomes. Now, facts and figures are out there about how long it takes people to save the full 20% deposit in whatever capital city you're in Australia. Certainly in Sydney, where I live now, it's just far too long to save 20%, and of course the market keeps moving ahead of everybody. I did a previous show on the fact that lenders' mortgage insurance, abbreviated to LMI, is not a big scary monster, and it's something that you should embrace. Joining me today as a very special guest is Strachan Taylor. We're not related, but we've both got parents that didn't want to call us Sean or John, and they've given us great names. You are from one of the country's leading mortgage insurance firms.
Yeah, thanks, Alan. So, Strachan Taylor, I'm the strategic partnership leader at Helia, formerly Genworth. And if you go right back, we were actually originally called HLIC, which was the Home Loan Insurance Corporation, which was set up by the federal government 58 years ago, 1965. Wow. Yeah. And the reason we were set up back then was because to buy a property, you had to actually save the 20%. Lenders were not allowed or wouldn't lend beyond 80% of the value of the property. And that was, even back then, that was keeping a lot of first home buyers out of the market. Right? So the government set up that insurance company, and the sort of contract was, okay, if you're going to lend over 80% of the value of the property, you need insurance, which will cover you from a risk perspective and make sure that the banking system is protected. And then the banks went, that's great. And they said to the borrowers, okay, we can lend you more. We can lend you over 80%. In fact, we could lend you up to 95%, but it needs insurance. And if you want to get in the market early, then you'll pay for the insurance. And that's how lenders' mortgage insurance was established. And fast forward, 58 years, it's still in the market. The product's virtually the same. It covers lenders for both in case a loan goes under and they lose money because the value of the property doesn't cover the loan. Mm-hmm. It also provides lenders additional capital. Now, that gets a bit complex for first-time borrowers, but basically whenever a lender lends, they've got to put a chunk of money aside to cover that loan for risk.
Yep. Right.
And so if they have LMI, that means they only have to put a smaller amount aside. They still have to put money aside, but a smaller amount. They're called risk-weighted assets. It's an assessment that all the risk guys do at banks. And if they don't have to put as much aside, it means they can lend more. Right? Yep. So it keeps more liquidity in the market as well.
Is it something that the general public, that you shop around for yourself?
Well, they can. Generally what we say is that focus on getting the money, focus on who will lend to you first.
Yep. Right,
and have that conversation with your broker, because the broker is probably your best port of call in that they pretty much can look at the entire market, or at least the lenders that they have access to. And then the conversation then goes, all right, well, how am I going to get into the market, right? And lenders' mortgage insurance is a pathway. It's not the only. It is one of many pathways.
Yeah.
But borrowers should be aware of it so they can have that conversation with brokers. And it can be, look, I've only got a 5% deposit, so what can I do? Have you got mum and dad that can kick in some more? Well, yes or no.
The famous right? bank of mum and dad.
Yeah. Exactly. And if not, well, then what else can we do? Government schemes, is that going to get you there? And if, you can use a mix, government scheme and LMI, and there's a whole lot of things you can do. But if it gets down to LMI, then it's actually talking to, well, which banks have it and what are the rates? And the rates do vary by bank, and that's all based on risk and the negotiations we've had. Ask your broker to have a look. Generally, the first thing is who's going to lend to me and can I afford it?
Yep. Now, if I go back to my broking days, when I would sit across the table from a client who has been told by their uncle that mortgage insurance is just a massive rip-off.
Yep. Uninformed comment, but that's fine. We get a lot of that.
I do know the answer to that question. It was a loaded question again.
But it's a good one because it does come up and you get those responses. And they're generally responses, but being a little bit uninformed. It is a cost, right? But you've got to focus on what it's actually going to do for you, right? And as I said, LMI is not for everyone. It will be too expensive for you or not ready for you yet, but it's something to consider. And the thing I really look at is what is it actually going to do for you? And the example I give is if you look at Sydney, the market I know quite well, over the last 30 years, and this is CoreLogic data, Sydney property prices on average have gone up by 6% per year on year. And that's through the ups and downs. Some years they've gone, you look just through COVID, there were sort of figures like 20%, right?
Yep.
But there's also been 10, 15% drops and things like that. But year on year, pretty much, just a straight line, compound annual growth of 6%. In Sydney, you're going to have to pay around about $1 million to get into a property.
Yeah,
right? A little bit less for a unit, but let's just use $1 million because it's a sort of nice round number. Now, if you're borrowing 95%, so $950,000, big loan, granted, but that'll get you into a $1 million property. The insurance on that, the mortgage insurance on that, is a little bit under $40,000. That's a big chunk of money. So you can understand when people see that.
That's a nice car.
Exactly. And people see that figure and so the initial, that's a lot of money, that's a rip-off, right?
Yep.
Yeah, but what's it going to do? It's going to get you into that house.
Yep.
Right? And I'll use 40 because it's an easy number to work with. So additional cost of $40,000. Now, you don't have to pay that up front. You can put that onto your loan. Right?
Yeah.
As long as you can service it, that $40,000 goes onto your loan. Probably kicks up your monthly repayments by $10, $15, $20 a month. But that gets you into the house.
Yes.
Now, if you're looking at the average compound annual growth, 6%, within 12 months, that $1 million property is worth $1,060,000. Cost you $40,000 to get in, right? The other thing is it's probably got you in the market 5 years, within 5 years. Now, you were talking how long it takes. Numbers, depending on who you are, it's between 12 and 17 years to save a 20% deposit to get into a property in Sydney. With LMI, if you only need 5% plus costs, right, you're probably looking at 5 years. So you're in 10-ish years early. So where's property going to be in 10 years' time? So you've got to look at the benefit and not just the raw cost. The raw cost, if you don't understand what it's doing, yes, you think that's a rip-off.
Yeah.
But if you sit back and really look at what it's doing, then you might change your opinion.
We had a show the other week looking at the issues that people have doing their own research and how you can confuse yourself if you actually don't know what you're looking at.
Totally.
This is something then that when people are sitting with their mortgage broker, get them to run this is if you save up 20% and this is if we look at doing it a bit sooner and utilising this wonderful tool, Lender's Mortgage. I'm very biased towards it.
Look, and talking of tools, so borrowers or borrowers with their brokers, Helia have a tool on our website which anyone can access called the Deposit Comparison Estimator. Right? And what that does is allows you to enter in numbers about how much you've actually saved, how much rent you're paying. Right?
Yes.
So that's another thing in terms of cost. And then look at your opportunities you have out there to get the deposit you need to get into a house. And it looks at government schemes, it looks at the bank of mum and dad, it looks at LMI. It allows you to put all those in and then it'll give you the pros and cons on each. Right? So it allows borrowers to get much more informed about how they can get that deposit. And then they can have a far more meaningful conversation with brokers and ultimately with lenders. Yeah,
it is a great tool. I did use it last week. I did play around with it.
Excellent.
And I did try and trick it too. And I thought it was fantastic. Yeah. And you can do the comparison between all the different ones. And being quite honest, it's nothing that's going to spoil your conversation with a mortgage broker as well. It's not telling you what you should or you shouldn't do. It's actually it's
presenting options, and also it's informing and educating. And I think and you'd agree with this that for any borrower entering the market for the first time or even seasoned borrowers, it is absolutely critical that you educate yourself and get help in an industry which is quite big and can be quite scary and complex if you don't know what you're looking at.
Yeah, absolutely. And there's the pressure of the time restraints that we often put on ourselves as well. So taking the time to consider the best options for everybody is important. The number one thing for me, especially for first home buyers, is that it frees up cash, even for first time investors. I was taught by my father and his business partner years ago that if you ever needed $10,000 quickly, you can't sell the bathroom on the investment property.
That's right.
So mortgage insurance, I think, can, for a lot of people, give you some comfort and some flexibility within this too.
Yep.
So
very much so.
Thank you for your time today, for coming in and explaining all of this as well. I will put a link in for that calculator.
Yes, do. And we've got a lot of stuff on our website, helia.com.au, that just educational material, not just the calculator, but please, definitely use the calculator. There are videos, there's information, things you can download. It's worth investing, half an hour to an hour's time, just working your way through it. You'll come out much more informed.
I do agree. Thank you again for coming in. If you like today's show, hit the like button. Tell your friends about it as well, especially those first-time investors and first-home buyers too. Very important subject here, and we'll see you all again next week for another edition of the Clever Investor Podcast.
Thank you.
You have been listening to the Clever Investor Podcast, proudly sponsored this week by Blue Wealth Property. Are you ready to start a new investment journey? Get in touch with the industry leaders, Blue Wealth Property. Blue Wealth have a proven track record in using research to identify growth markets, and Blue Wealth have supported thousands of Australians to buy the right property in the right market at the right time. Go to bluewealth.com.au.